Hey guys, welcome to my balance sheet video. I'm making this video for my principal students early in our money and banking unit because there's a few different kinds of balance sheets and it might help to see them all next to each other. So we're going to talk about households and firms and their assets and liabilities. We're going to talk about different banks and thrifts and their assets and liabilities. And we're going to talk about the Federal Reserve System and their assets and liabilities, because we're going to find that everyone's a little bit different. So let's start with our households and firms. Assets. What assets do we have? An asset is something good for us that gives us claim on resources or on someone else's income. So one form of asset that households can have is currency. Currency is something we can use right now to go out and get resources. Another is bank deposits, and those are usually the big ones, but of course we can have other assets too. For instance, you may own various financial assets or whatever else, but we're just taking this at a really general level. What kinds of liabilities does a household have? Well, they can have bank loans. A bank loan, well, that's something they have to keep paying back. That's when someone else has a claim on my income, and so it's a liability, because it's going to take from me in the future. And then I can also have other liabilities. Maybe you're locked into a lease or something. And then we usually put net worth on this side as well. Our assets will equal liabilities plus net worth. And if I want to rewrite that, I can say that my net worth is equal to my assets minus my liabilities. So that's why we put it in here. It makes this all balance out, because whatever's on the left side has to add up to whatever's on the right side. So there's household or firm's balance sheet. Those are the main things we're interested in this money and banking section. Let's go look at banks now. What does a bank call an asset? Well, a bank's assets, they have reserves, two main kinds. There is a deposit at the Fed, where their money is safe with the Fed and the Fed will give it back when they want to. And there is vault cash, or currency in the vault. Those are two of the kinds of assets that a bank has. Another kind of asset is their loans. Their loans give them claim on people's incomes over the duration of the loan. And they might also have other assets. For instance, they might purchase some government debt or something like that. Now, one thing to note is that a bank calls a loan an asset, but a regular person or a company calls a loan a liability. Why is that? It's two sides of the same coin. To the person who took out the loan means I have to pay a bunch of money. That's a liability. To the person who gave out the loan, they're going to collect a lot of money, and that is an asset. So that's what's going on there. What about their liabilities? Well, bank deposits are a liability, because their customers can come back at any time and say, give me my money back. They also might have just we'll put a catch-all, other liabilities, such as they might have borrowed money from a different bank or from the Federal Reserve. And then we put their net worth, or owner's equity, or capital, whatever you want to call it. I usually avoid calling it capital in my class because we have two synonyms, and I don't want to get people confused with physical capital. But anyway, something else to notice. These deposits, liabilities for the bank, assets for the rest of us. It all depends on who's on what side of it. They play into a bank and another person's balance sheet in opposite ways, just like with loans. Now let's look at the Federal Reserve System, because this one's another interesting one. For the Federal Reserve, their assets, they have government securities, which, they buy up a lot of government debt, for instance, and they can buy other assets. For instance, during quantitative easing after the Great Recession, they purchased a lot of those mortgage-backed securities we talked about. So they can buy all kinds of stuff. What about their liabilities? Their liabilities are the monetary base. Now, what is the monetary base? There's two pieces. There's currency, and there is reserve deposits. Now, one thing that's important to point out is that this currency includes two different things. It includes the currency in circulation that our households have, and it includes the currency that is being kept in vaults as reserves. Those two things combined are the currency portion of the monetary base. So, the monetary base, unlike the money supply, which is my last video, the monetary base includes currency in circulation and also currency in the vault. It also includes reserve deposits. I guess let me explain one last thing. Why is currency a liability? Well, I find it helps to think back to the Fed's origins when we had like a gold standard. The Federal Reserve had a bunch of gold and other metals, like silver, where if you brought $1 to the bank, you could exchange it for a little bit of metal. And so the bank had to be ready to pay out for every dollar that was in circulation. And so with that in mind, it's really easy to think of cash as a liability. It's a little harder now because we have a fiat money system, but the idea is still the same. The Fed issues all this cash, and then the Fed will be accountable for how the cash is used. And it's still a liability to them because they're in charge of it. And if it blows up, it's their fault. Anyway, I hope these three things are worth your while. It can be a little confusing, but as long as you can keep it all straight, it's pretty simple. So, good luck, you guys. I will make another video soon on how banks create money, but I'm done for today. Thanks for watching, guys. Good luck and happy